All right, so it's been a few days since I've done this video, but in the time since I've last been here, a lot of those really oversold technical patterns that we talked about on Friday's market outlook appear to have set the stage for the rally that's occurred this week. So we've had a nice little jump. I'm going to break down how bullish we've been and whether it's been enough to say, okay, here we go, or whether it's just a trap, a bear trap. And that we're expected to continue to be pretty darn bearish going to the downside, and what the technicals are telling us there, and with this rally and renewed optimism, are we able to trade it or not? So we're going to break that down with our trade idea as well. So let's go ahead and get started. Today is Thursday, June the 6th, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first with the market forecast indicator as always. And you can see the strong short-term sentiment. So, when you've got the momentum line or the intermediate line in the reversal zone, remember we talked about, how bullish of a signal last time that I did the outlook video, how bullish of a signal it was to get the intermediate line below 10 and the cluster. All right, and then obviously the other signals we got as well with the on the weekly chart, the near-term line got down below 10. On the monthly chart, the momentum line got down to an extreme low. I mean, these are all things that in the past has been very bullish on their own, and to get them all on the same day, in the last day of May, is pretty darn rare. And you can see since the bounce we're getting now, of course, there's headlines influencing a lot of this bounce, but the environment was very oversold. So the environment was there for any kind of bullish headline to produce the type of rally we've gotten here. Now, we're not bullish by any extent, right? We have light green shading because we have a bullish posture on the intermediate line. It's not above 50 yet. Now, in the past, as I mentioned before on Friday, when we are below 10, we usually get there pretty, the move up when we're bullish, when we're not in a death cross environment, when the long-term posture is still bullish, the long-term posture, like the moving averages, 15 200-day moving averages, then we typically get up to 90 pretty quick. So, or 80, but in the past it's been up to all the way to 90. So the expectation is this green line will get up there. And the momentum line is your first sign that we are now going to turn bullish. The red line getting up to this extreme up here above 90, and then the near-term line is your second sign. So we got really up here above 80. You can see that doesn't happen when you're not very bullish. You had a little bit of a bounce here. Barring the tweets, and then the FOMC, we were looking good for a setup for a bounce right there, similar to what we got here. But of course, we really sold off. And again, how significant was that? Well, we reversed that rally here in the first couple of months of the year. So that kind of puts that rally or that fall into context that, again, it was very headline driven and wasn't really meaningful, significant in terms of its staying power because we reversed it so quickly. But, you see really good signs here. The Dow Jones is showing very strong short-term sentiment signs that you would expect to lead to a good, strong bullish posture, which means the green line getting above 50. You can also see the NASDAQ composite finally getting its light green shading today, getting barely above. The momentum line not as bullish because we had the long lower shadow yesterday, but the near-term line is. So again, the momentum line's not as necessary as the near-term line is to get up here above 80, get that strong move. And of course, the Russell 2000s had a couple of weekdays here this week, but initially a good strong bounce and closing obviously above, the high of the low day after a couple of clusters itself, and also getting below 10. Now it gets below 10 a little bit more frequently. The S&P 500 doesn't get below 10 very frequently. So the fact that the intermediate line on the Russell is down there, and they got a couple of clusters, you can look at it the same way. And it actually pulled back a little bit more into the 50% retracement, whereas the Dow Jones Industrial Average pulled back right to where we kind of expected it would with the retracement lines. You can see getting down to this area here, 2720, a little bit above that, right into the Fibonacci fan area there. So it pulled down to that support area. Now the initial support was up here at 2800. And here, let's get rid of this line. I'll remove that one. But you can see the initial support was at the 2800, and we were holding that for a while, and we broke through to the next layer, the next Fibonacci layer, that 38, and found some support and bounced, and has since bounced back up above the 38% Fibonacci fan. So it's already cleared the Fibonacci retracement zone and gotten back up above the 23%. In fact, gotten back up above, significantly above 2800, which was such a good support level for a while in the pullback, and now right back up above it. So strong bounce back here, and the market forecast signifies, kind of reflects that with the strong short-term sentiment patterns that, like I said before, lead us to expectations that the green line will make a good run. And of course, that's what we would expect coming from below 10 in a long-term bullish environment, and the short-term sentiment says keep on expecting it. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, then hit that red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells us with one click that you want us to do the video again tomorrow. So it's a quick, easy way to give us feedback you can do right now while you're watching. Also down there, comment on anything that stood out to you from today's video. Join our daily market outlook email list. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our daily email. A quick and easy way to do that. Follow us on Twitter for more content in between videos from day to day, and join our market outlook community that we created on Facebook. We also invite you to subscribe to our marketscholars.com, to our website here. If you're watching the Outlook on the blog post, with a link to our blog post, right up to the right, there's a link that says subscribe. You can do it for free. That allows you to participate in our forums that we have specifically for the Market Outlook. There's a link to that one forum. Of course, our forums for our classes are for our premium subscribers, as well as all of our classes over here. You can see I'm back to teaching tomorrow in my technical analysis class. But at least you can participate to our forums, as well as we release new content, course content in the future. You'd have access to some of that as well. We also ask that you like our Market Outlook tweets and Facebook posts. That way you're telling Twitter and Facebook that you want them to keep you in the loop when we put stuff out there. And the best way to do that is to engage with our stuff. And we make it really easy for you. You can do it right here. Just click this heart. Opens up a new window. You can like tonight's tweet. Click that image. It takes you to your Facebook page. You can like tonight's Market Outlook Facebook post there. And then again, like I said, that will keep you in the loop for everything else that we share. All right, back to the charts, and we'll look at the S&P 500. Look at that weekly chart. So again, this was not a surprise. We talked about this. We've seen this before, and here's a couple of weeks coming after a golden cross. So you test the 200-day moving average. You trade in between the 15 to 200-day moving average after pulling away from it. You might even close below the 200-day moving average, and then you bounce. For whatever the headline, we don't even know what the headlines were there. Well, actually, we do. That was the election, November of 2016. But you get the idea. I mean, here was the Ebola virus. Again, closing below the 200-day moving average and then gapping right up the next week and getting back above 50. So very, very common pattern, this engulfing pattern that we're getting so far this week. Not a surprise at all. And we talked about the idea that the Hakenyashi candle this week could be a transition candle. Well, look there. I mean, we're getting the transition candle, right? We're getting a small body, and that will get smaller if we continue to close up here or push up higher, and then you're getting the upper and the lower shadow there. So transitioning potentially to a candle like this for next week would start us our turnaround. Now, there we got a couple more transition candles before we've got entrenched, but you get the idea that we were looking for a candle like this after a few weeks of getting towards the 200. We're getting the candle like this, and now we expect for that body potentially to get even smaller the rest of this week into tomorrow, and then more of a candle like this potentially for next week, and then the continued trend. to the upside. Let's take a look at the 3 green arrow charts. You can see we're not getting 3 green arrows because we're not above the moving average yet. So that's why we're not bullish yet, right? We're not above this high point that's in between these two lows. If you take a look at the the MACD and stochastics, though, you can see we're still below 50 on the stochastics, still below 0 on the MACD, but we're above rising moving averages. We're above the 17. So today we made the break above the 17 and cleared that. Now the next stage is for the MACD to get above 0. That means the green line will cross the red, and then for both of these lines to get up above. And you notice we might converge over a longer period of time and bring the MACD down over a longer period of time. But the MACD on the downside, we don't converge slowly to 0. We typically run right back up above 0 and get back up to a new surge high point and then converge for a long period like this as we maintain a bullish trend. So that would be the expectation again for the MACD going forward from here. All right, now let's take a look at the intraday chart. Look at that rally. I mean, this was a a little bit of weakness on Monday, but then boom, 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 boom. And right, there's the Hakunashi Open for this week. Obviously, the dotted line's the midpoint of the 4-week range, so we're easily back in the upper half. And today, we got above last week's high. So an outside week for the S&P 500. Starting the week with a low, going to new lower low and a new 4-week low point, but now moving up to, in fact, we're only a few points away from the 4-week high point. Remember, that's going to come down a smidgen down to this level and be there for about a week. Not very much, but you can see we're getting a lot closer to the 4-week high point. If you look at today's volume and trading range, for the S&P 500, at least for the ETF for the S&P 500, you can see the trading range. We didn't have a gap. We filled in the gap. So the close at 282.96 and today's low came down to below that. So we filled in the gap this morning after the open. You can see it better again here. We had a gap, a little bit of a gap to the upside. Then we came down, filled it in, and then we rallied up here. But going back to the range, so no overnight gap here that we need to account for. The range is 3 points, and the volume is at 69 million. So you look at the volume here. When you look at this chart, 69 million is obviously below the average, so it's going to bring it down. 3 points is below the ATR. It's going to bring it down. And as I mentioned before, during the rally, during this pullback, that wasn't nearly as volatile as like this pullback was. Right. In fact, you can see it on the volatility chart here, and I mentioned to you before last week. And here, let me get rid of that market maker move really quick. But you can see, we just weren't getting the big up and down moves here. We only got a couple down, a few down moves here and there, and then now, boom, the reversal and the big moves to the upside. It's a good sign. It's a good sign for the market. Obviously, breaking below whatever trend line you would want to draw here during the decline. Obviously, the next stage would be to break above this little kind of near-term high point that we had. That would be your next stage to clear to really, and again, we even mentioned that before over in this area when we bounced up here. We said it's got to clear 290 before we really feel good that now we're starting a new intermediate run. And I would still contend that that's the same thing. We have to clear above 290 to really say that this new intermediate run that we got, that we're kind of getting going here, is really going to take off 2,900 on SPX. So again, we're not there, but I do expect that we will get there because of the technical patterns that we're seeing here. Finally, we'll take a look at the VIX. And remember how the VIX never did get up nearly as high as we would have expected it to during this decline. Well, we did get up closer to 20 on Monday initially, but since then, look how fast we're already back down to below 16. So, and we're back down to neutral. So again, we're not bullish yet. We're not, it's not entrenched there until you get below the 90%. That's when we're set. And then now that we've had this move, now that we've had the surge, and we've had a little bit of a bullish bounce, and then we had this next volatility run, while we didn't get to the lower half of the bullish range for volatility, at least bullish for the stock market over here. We did not get there here. So now I would expect that we would. That would be the next stage of the volatility coming back down. Of course, getting below 15, getting below 90% would confirm that we're now starting a new intermediate run to last the expected 1 to 3 months, and the long-term trend to pick back up again, back to the upside. All right, so to summarize, before we look at what's driving the price action and our trade idea of the day, to summarize our technical outlook here, we're getting a bounce. We were extremely oversold heading into Friday's video that I did heading into the weekend, and now we're getting the technical bounce that that oversold environment had laid the stage for. We're not there yet. We're not entrenched in this bullish bounce. It takes a while when you're as oversold as we were. So we're not all the way there yet. And there can still be a bearish near-term run before we get there. But we're on our way. We're making some good headway here from a technical perspective, no matter what the headlines are that are driving it from the upside that we'll talk about later. So, and the expectations will continue to move our way in that direction. So with that being said, what do you think? Do you agree with that outlook or do you disagree? There's a link popping out right there on the top right corner of your screen. Hit that link. It opens up a poll. Vote. You can vote there for either agree or disagree. If you disagree, scroll to the comment section. Let us know down there what you're seeing that would suggest maybe this is maybe like a bear trap. That you're a lot more bearish, you're not sold into this bullish run. Maybe you see some other technical or macro signs that would suggest that, or whether you might be a lot more bullish than even the technical outlook says that we're even at right now with what we look at in this video. So let us know down below. All right, now let's take a look at the price action and what's driving this. And of course, I couldn't tweet for my friendly screen capture as well as I would like to as I was away. But what was interesting about the rally here yesterday and the day before was it wasn't accompanied by a strong move higher in crude oil, which was typical. Now, crude oil did rally late today, but it's still down for the week. In fact, if I were just to look at the week here alone, so we'll go out here to June, go to June 3rd and go to 10. You can see it's still not up for the week. It's close, but it's not quite up there. And it's the S&P that's doing the best, even outperforming small cap stocks for the week. And interestingly enough, gold remains higher for the week, not your most typical risk off move. In fact, that pattern of gold outpacing crude oil is not your typical risk on behavior either. And then, of course, developing markets, EFA, way outpacing emerging markets. Also not your typical, especially in a bearish dollar move. That's a move we talked about a lot, this bearish dollar, and we weren't quite sold on that breakout. In fact, a little worried about the fake out moves above 98 because they were never able to hold. Well, now we see why we were so concerned. In fact, now we have a bearish pattern here of red line, dark pink shading on the dollar, coming down to a trend line, and we're trading around that trend line. So we're not breaking down yet, but not looking as good for the dollar there. And if I take a look at the 3 green arrow chart for the dollar, you can see, again, 3 red arrows breaking below the previous 3 red arrow low point. So that's a pretty bearish sign in and of itself, which is actually bullish for stocks when the dollar is dropping as it is. And you can see on the weekly chart, it's not as bearish yet because we're not below the 200, and we're not below. Getting really bearish would be getting below 94. So we're not below 94 yet. But it's looking like it's going to make a run towards this 96 level on the dollar. And of course, and the main reason why is because you're continuing to get, a move lower this week. I mean, this week's move on yields has just been tremendous to the downside, or this last week, excuse me, and this week holding so far. I don't believe we'll go that much lower than this because we are well below the Fed funds rate on there, and that's kind of a lower bound until the Fed decides to cut interest. which you can see on this chart. Right now, heading into July, there's a 70% chance that they will cut rates as soon as July. By September, we're looking at a 90% chance. So I mean, we could get a rate cut really soon by the end of the summer. And then you can see what's interesting is we got a lot of months here. By December, you notice that there's a pretty decent chance, about an 83% chance that we'll get not just one but two rate cuts by the end of the year. But once you go out to June and you say, okay, well, there's a 99% chance we'll get a rate cut by next June. There's a 90 some odd percent chance that we'll get a second rate cut. But now we're looking at about there's a 20. There's about 30% chance. So we got about a 70% chance of a third one, which is high probability, but it's not baked in the cake. And that's all the way out through June. So that's a lot of meetings here. The Fed rate hike cycle is to do it every, from June to September to December. And so it seems to be the pace that they're on. September, there's a high chance of a rate cut. December, there's a high chance of a second cut by the end of the year. And then the third one, through the first 6 months of next year, the third one, there's a high chance of one, just not right now baked in the cake, not above 80%, which is where we really kind of bake that in there. So we keep our eyes on that, but it's kind of interesting that the futures market is suggesting we may be a kind of a short run rate cut cycle, similar to what we saw in 1995. Remember 1995, the yield curve here, if I were to go out a little bit further, 1995 is right here, and you can see we had one rate cut, very similar to what we have here, where it came very quickly after a rate hike, and you notice it didn't stay down. In fact, you can see the yield curve continue to come down. It finally inverted in 98, the 210 yield curve. So a lot of people are suggesting that we might be in a similar mode here to what we saw in 95 after the Fed rate hike cycle of 94 put a lot of pressure on stocks. Well, that last rate hike in December, as we saw, and the tariffs for that matter, but that last rate hike put a lot of pressure on stocks, on the stock market, and we might be getting a similar run. And if you recall how the stock market proceeded from the end of 95 going forward, here, if I were to go back further out in time, here's 95. We'll zoom in right in that area. If it won't let me here, let's do this. Let's go to time frame. We'll do custom, and we'll go to 1990, and then we'll come here to 1999, and we'll go on a weekly chart. So there's a 10-year weekly chart through the 90s. There's your kind of death cross environment in 94, and you can see after that rate cut in 95, the market priced it in and was very happy about it. And then because it didn't lead to a recession, it wasn't multiple rate cuts, it was just the one. Look how the market responded the rest of the 90s. Now, of course, lots of other variables that produce that, but the idea of a quick and not a protracted rate cut cycle that would bring the entire yield curve back down closer to a lower bound, which we can see we're already at essentially the same level that we hit the lower bound after the early 2000s recession. So the lower bound's most likely going to be close to zero again, like we were for a very long time this last decade. So either we're going to do one or two quick ones and then stop and then continue the rally, or we're heading back towards. But the nice thing is, this idea, this talk of an inverted yield curve being bearish and leading to recession is true, but not immediately, right? We can be down here for a long time, down in the lower end of this, and it's actually not a bad thing to be down here in the lower end of the yield spread, because once you start rising, and it's not rising, and the yield spread is not rising, see, eventually the yield spread will rise because you'll see some rise, some lift in the long-term interest rates. They'll start to rise up here while the 2-year stays. And that's a good reason for it to rise. You can see same thing here. That's when it's rising at the end of the cycle, great. Same thing over here, a nice rise as the long-term rates rose. But when it rises early, it rises because the short-term rates are falling sharply due to a more extended rate cut cycle. So, it looks as of right now that we're more leaning towards it being a short-term temporary, maybe one at least, if not two, and then a decent chance for more. But kind of, I think the market's got. Let's see what 1 and 2 does to the market. Of course, it's putting pressure on the dollar, and that's actually not a bad thing for stocks, especially for the foreign markets. The foreign markets really need some help, right? Because they've had a lot more pressure on them than the U.S. stock markets. But you can see a lot of green here. I mean, now we don't have green lines. We only have the green line in Brazil. We have a green line in Russia, and we have a green line in India. The rest of them are still red. We're still trading below falling moving averages. It's like the S&P, but we have a lot of green. These weak short-term, weak bullish postures, but we're not strongly bearish anymore either. Like incidentally, China actually still is. Now, what's actually interesting here, and you can see, look at the rally that we've had in utilities. Up to 3-month high. The rally we've had in real estate up to 3-month high. Again, interest rate sensitive areas, strong bullish postures above 50 on the intermediate line and rising, and dark green line. So very, very bullish there. Not surprising to see technology, industrials, these cyclical areas, communication services, consumer discretionary. They're all below falling moving averages still, just like the broad market as a whole. So that's not surprising either. But now you start to see like staples is bouncing up, healthcare is bouncing up above rising moving averages. Materials has really taken off, and that's a very positive development. Again, that's your dollar sensitive area. So the weakness in the dollar here, really helping, and not quite helping energy yet, because crude oil still continues to be pressured and is just now bouncing back. And that would help lift. You'd expect these two areas to start working their way back towards the top of this if the dollar continues to go down. And if yields stay pressured, you'd expect those. I wouldn't expect yields to stay pressured for too much longer. I would start to look for yields to rally here off of these really oversold levels like the broad market itself is doing. But the rally in utilities and real estate brings me back to this chart, and I've shown you this before. You can see our best performing sectors over the last 200 days relative to the S&P 500 continues to be utilities and real estate and staples, right? This is a bullish pattern. Because again, this is the past 200 days. This doesn't tell me, okay, over the next 200 days going forward from today, this is what we expect to lead. No, this is what's happened from 200 days up till now. And so again, you can see that the underperformance in the cyclical areas, and in particular the dollar sensitive areas, these are the areas now going forward from here we would expect to have really strong gains with these to start to pull back. Right. So remember, again, while these safe haven sectors have been very good and outperforming, that's reflective of an environment that hasn't been very bullish in the markets, and we've seen that, right? The S&P 500 has been pretty volatile, but from a long-term perspective, if you go back, again, a couple of 200 days is not a couple of years, but to kind of show you, a perspective on this. If you go back, a year and a half, the market hasn't moved hardly at all. In fact, it's actually from last September, October. The chart here goes back to August 20th of 2018. So August of 2018, 20th, is right there. It's that week right here. And you can see where my horizontal line is over to the right. We're actually below that. So again, the fact that those sectors have been outperforming is reflective of a pretty volatile environment that we've been in, and it's actually a bullish sign going forward from here. That they've outperformed so much and so well, we would expect cyclical areas to start to outperform, and again, that's suggestive of more of a bullish rally into the end of the year. Again, you would wait, it won't take hold until you get above 2,900, but another sign from a sector rotation standpoint that we weren't as bearish. I mean, again, going all the way back to these last so many days here, and into the end of March, and the outperformance we had in these areas. It's reflective of how bearish that we were and how volatile that we've been, but it's not reflective of how bearish we expect to be going forward. I think if people get too wrapped up into how much we've dropped and think, okay, well, because we've dropped this much, now we're going to be really bearish going forward from here. And the reality is, it's actually the other way around. Because we've dropped so much, we can actually expect to be pretty bullish going forward from here. Just like we were, like I said, on Friday's video with all those rare oversold patterns that we saw. One of those cyclical area stocks, it's one of those cyclical areas that's actually, had this nice little rally. Of course, Disney had this nice little breakout move earlier. It's formed a little volume node in this area, but well above the volume area, the volume value area where 70% of the volume is. So it's held up in there. You see we're breaking back up above the upper Bollinger Band. Not to an extreme, but we're breaking up above the Bollinger Band with a rising, very low Bollinger Band width. If you take a look at the market forecast for Disney, it looks very similar to the broad market itself. It does have a green line, actually, unlike the S&P 500, but strong short-term sentiment leading to a change in posture. It's weak currently, but again, with that strong short-term pattern, you expect that week to turn stronger, especially getting up above this kind of prior near-term high point here. If you look at the 3 green arrow chart for Disney, you can see we're back to 3 green arrows. If you take a look at the 2-line versions of where that MACD and stochastics are, you can see MACD back up above its moving average and above 0 with barely getting below. You can see the moving averages up above here. Are the greens crossed above the red, but they both haven't crossed above the 30 yet. But you can see how they're getting closer. The DMI kind of helps confirm that with the positive line getting above 25 here after a brief drop below. We were so bullish here with this breakout. The ADX was so high that it took a while for the blue line to get back below 25. Never did get below 20. Bounced back up. The orange line was so far down. Finally got up above 20, but went back down below it. So bullish pattern there. Bullish bounce. Getting pretty bullish as it is, so you don't know how much to expect with such strong numbers, especially in the short term. You look at the rate of change for Disney over 3 months, and that's still a really high number, 3-month period. So we're not looking for good, huge moves. You'd be looking more for that down here to the downside at these really low levels. So we're not looking for the big run up to the top side, but it's got a good bullish pattern. Then we can say, okay, let's sell the 135 put and buy the 130 and see if we can get filled in around $1. Again, we need $1.16 at least to get filled in there. But if we can get that, you can see we get a high probability of making money on it. The break even, if you take a look at where the break even would be, let's look at it here on the kind of intraday chart for Disney. You can see the break even is back into the lower half of the 4-week range. So you've got some, we're getting new 4-week highs as we speak. That's one of the reasons why it kind of showed up on my radar. It's got the new 4-week high point, and it's got a lot of room to work with before you get back into the lower half of the 4-week range, which is where the break-even level is. And of course, if we get down to there, you're trying to make 139, so we're willing to lose 139. At that point right there, it's under 139. So we got a little bit of room to work with before we get to the point where we would lose. So it would have to drop through the midpoint of the range and then down further for us to lose as much as we would be willing to before we close out of the trade. Okay, so that wraps us up for today, and you've heard from me again after a few days off. Now I want to hear from you. So use that link at the top right corner of your screen. Go to the Market Outlook forums on marketscholars.com, and let's continue the conversation. What questions or comments do you have about what we discussed in tonight's video, or anything we didn't discuss in the video that pertains to this market outlook, this market posture idea? Let's keep the conversation open up. Any new threads or a reply to anybody else's threads there. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit the thumbs up icon, and comment on the video. Follow us on Twitter for more content from day to day in between videos. And again, join our community on Facebook as well as subscribing for free to our marketscholars.com website to participate in our community and our forums there. So again, thanks everybody. Have a great rest of your evening, and we'll see you all tomorrow.